Well, Marc Faber told investors in March of 2009, March 9th to be exact, when the S&P reached its lowest level since 1996 to buy stocks. Now, the S&P, as you know, rallied nearly 80% from that low. And then, at the beginning of March of this year, he predicted a 20% decrease in the S&P if the index reached a new high. Well, as you know, the S&P has tumbled more than 13% since reaching that high on April 23rd. Needless to say, he has been right on many major market calls. Joining us right now to talk about his latest call, and he laughs, Marc Faber, publisher of the Gloom, Boom, and Doom.
Not a bad run, Mark.
Because I've been also wrong on many market calls.
Well, that's fair, but you've been right on two big ones in the last couple of years.
Actually, it was March 6, 2009, when you called me. I was in Vancouver. That's why I remember you. So I think that maybe today we're in a similar position where the markets can rally a bit.
You think so?
Well, I mean, we've come hard down, and many stocks are down 25%. The Ukraine stock market is down 40%. The euro has collapsed. So we have near-term extremes. Sentiment on stocks is very negative because of Europe, because of North Korea, because of everything.
Right.
And nothing looks very good, but the market is a discounting mechanism, and we've come hard already, and we're oversold near-term. Not from a longer-term perspective. But secondly, there is a lot of support around 1,045 on the S&P, which was the February 5th low 2010, when we had made the high March 19th of this year, when the S&P had gone to 1,151, and then we dropped to 1,045. So around this level, 1,050, there's quite a lot of support.
Isn't there concern, though, still about the European banking system? I mean, whether or not Europe comes out correctly in their role as lender of last resort?
Listen, the banks are gone, but equally, interest rates are at zero, and the governments will print and support them. And don't overlook the fact that since the stock market began to decline after March 26th of this year from 1,200, what were we at the peak? 219. The bond market has rallied very strongly. We're up 10% on the long bond market. So interest rates on the 10-year Treasury that were close to 4%, they dropped now to below 3.20%. So that is essentially a positive also to look at.
You know, I want to fast forward, Mark. I mean, if we look, let's say, in October of this year, what do you think we're going to be talking about? Is it similar things, more sovereign debt concerns? Will that be resolved by then, do you think, at this point? Will the nations have enough?
Don't worry, there'll be some new problems.
So in other words, Greece, Spain, and then who's next?
We had a very weak May.
Right.
And the market is near-term oversold. June, July is, from a seasonal point of view, usually better months. In other words, there is a summer rally.
Right.
I don't think we'll go and make a new high above 1219 on the S&P. I think that area around 1200, 1220 is a lot of resistance. But I think we can rally here somewhat.
And this is what you've been saying, really. You're sticking basically then to your forecast that we rally a little bit in June and July, and then October and November are difficult again.
Yeah, I think we'll go down and then probably bottom out sometimes in October, November, because at that time the next big stimulus package comes in and the next money printing. Don't forget, a strong bond market in the U.S. and a strong U.S. dollar gives the Fed more ammunition to ease again massively. Right. That shouldn't be forgotten.
Right. Marc Faber. So, Mark, you're hearing kind of positives, some negatives?
Well, don't misunderstand me. I'm very bearish about everything.
I was going to say, these are just trading calls, right?
Yes, it's a trading call. We can rebound here, and no matter how bad things are, or the worse they are, the more money will be printed and the more fiscal stimulus will come on. So stocks could go up and the economy can deteriorate.
Right. So, but you're bearish call long term. Nothing's changed.
I'm bearish about everything.
I'm not surprised.
On geopolitics, on the only
gloom, boom, and doom. He can't go any other way.
The good news is the weather is nice in New York.
And you know, before we went to break, we're talking about your views on the U.S. economy long term. I thought it was interesting in David Levy's note today. He's bearish because he says Washington seems to be gradually shifting its focus away from fiscal stimulus towards deficit reduction. It sounds like the kind of thing that would make you laugh, make you actually a little bit more bullish, but can it really be done to the extent that it makes you happy with the U.S. economy?
Well, we'll have to see and distinguish between what they say and what they will do. I think the fiscal deficits will stay very high, and actually I think they'll go up and not down.
And this is the reason that long-term you're very bearish on the U.S. economy.
Well, I think that the private sector is the dynamic part of the economy, and if you shift essentially away from the private sector and you tax the private sector, and through regulation you make it very difficult for the private sector to know whether they should invest or not. Let's say if you have a corporation, there's so many new regulations that coming on, like health care and so forth, so you don't know how the future will look like. Are you going to hire and build new factories in America? I don't think so. So then the government takes the money away through taxation and gives it in transfer payments to people that are on the beach. Okay, doesn't disturb me because I'm not an American citizen, I don't work here. But if I was a working American and or a corporation that, or an executive that runs his business, and the money is taken away from me and given to people that actually don't work and are not productive, that is not a very happy state of the economy.
You know, Mark, Matt mentioned David Levy. He's going to be a guest on later. And he also says the chances of a double-dip recession have increased greatly for later this year. You think that is...
60% now.
I'm not so sure there was ever really a recovery, because if you look at federal tax receipts in April, they're still down vis-a-vis a year ago. And March, April 2009 were kind of the low point of the economy. You look at the stock of Walmart, it's no higher than it was a year ago. So Walmart is maybe telling you more about retail sales than government statistics.